Debt that never sleeps. It doesn't collapse with a crash or announce itself with panic. It grows quietly, compounding in the background, reshaping behavior long before consequences appear. And by the time it demands attention, it has already altered the system that created it. To understand why perpetual debt defines modern finance, we need to look at how borrowing stopped being temporary. In earlier eras, debt followed cycles. It expanded, contracted, and reset through repayment or default. Today, debt rarely disappears. It is rolled forward, refinanced, restructured, and extended, turning obligation into a permanent feature rather than a passing condition. This shift changed incentives across the system. Governments learned to finance long-term commitments through continuous issuance. Corporations optimized balance sheets around cheap borrowing rather than retained earnings. Households adjusted expectations, treating credit as a tool for stability rather than risk. Debt became normalized, even invisible, as long as payments remained manageable. Low interest rates accelerated the transformation. Servicing costs fell, masking the true scale of obligations. Borrowing felt safe, even prudent. Markets rewarded leverage. Growth depended less on productivity gains and more on financial expansion. As long as rates stayed low, the system appeared balanced. But debt that never sleeps requires constant motion. Refinancing must remain available. Liquidity must stay abundant. Confidence must hold. The system becomes less tolerant of disruption because obligations do not pause when conditions change. Cash flows tighten, but payments continue. Risk accumulates not through default, but through dependency. The earliest signs of strain appear subtly. Balance sheets stretch. Maturities shorten. Borrowers rely on access rather than repayment. Each decision is rational in isolation. Together, they create a structure that functions only under specific conditions. Conditions assumed to be permanent. This is a quiet buildup. A system designed around continuous debt becomes highly efficient in calm periods, yet increasingly sensitive to shifts in rates, liquidity, or growth. Stability depends not on reducing leverage, but on sustaining it indefinitely. The question is not whether debt is manageable today. It is whether a system built on obligations that never rest can adapt when the environment inevitably changes. Because debt may never sleep, but neither does the risk that comes with it. As debt became a permanent fixture, its role quietly expanded beyond financing into shaping behavior itself. Decisions across the economy began to assume that borrowing would always be available, affordable, and renewable. This assumption altered how institutions measured risk, how investors priced assets, and how policymakers responded to pressure. Debt was no longer a bridge. It became the road. Refinancing replaced repayment as a dominant strategy. Obligations were extended rather than reduced. Short-term maturities rolled into new issues. Balance sheets grew larger without appearing heavier. As long as markets cooperated, this structure felt stable. The act of paying down debt became less important than maintaining access to it. Financial markets reinforced the pattern. Investors, searching for yield in low-rate environments, eagerly absorbed new issuance. Demand kept borrowing costs low, validating the belief that leverage was sustainable. Rating agencies focused on serviceability rather than scale. As long as payments were made, size became secondary. Risk was assessed dynamically, not structurally. Governments followed similar logic. Deficits expanded to support growth, manage downturns, or respond to crises. The expectation was not elimination, but control. Debt became a policy tool, flexible, immediate, and politically palatable. Each successful intervention strengthened confidence in the model. Each calm period reduced urgency to reverse course. Corporations adapted quickly. Share buybacks replaced reinvestment. Expansion was financed through credit rather than retained profits. Earnings per share improved even as liabilities grew. The market rewarded these strategies, reinforcing incentives that favored leverage over resilience. Success depended on access to funding, not balance sheet reduction. Households experienced the shift more personally. Mortgages, student loans, and consumer credit extended timelines across decades. Payments fit monthly budgets, masking total obligation. Credit scores measure reliability, not vulnerability. As long as employment held and rates stayed low, Debt felt manageable, almost invisible, but the system's dependence deepened. Cash flow disruptions that once caused inconvenience now threatened stability. A rate increase, a liquidity shock, or a slowdown in growth carried amplified consequences. With little margin for error, adaptation became harder. Flexibility narrowed as commitments multiplied. Debt had become less about financing opportunity and more about sustaining structure. The economy learned to function with obligations constantly in motion, never fully resolved. And in doing so, it traded long-term adaptability for short-term continuity. The danger was not excess borrowing alone. It was the assumption that debt could always be rolled forward, without pause, without repricing, without consequence. Because when a system depends on motion to survive, even a brief interruption can change everything. The conflict emerges when the conditions that sustain constant borrowing begin to shift. Growth slows, rates rise, liquidity tightens. Each change on its own appears manageable, but together they expose how little room remains for adjustment. A system built on perpetual refinancing suddenly faces a possibility of interruption, and it is unprepared for stillness. Borrowers feel the pressure first. Companies accustomed to cheap credit confront higher costs that compress margins overnight. Governments discover that servicing obligations absorbs resources once allocated elsewhere. Households watch monthly payments creep upward. Eroding flexibility they did not realize they had already lost. Debt that once felt passive now demands attention. Markets react quickly. Risk premiums rise. Investors become selective. Issuance slows. What was once assumed to be renewable must now be justified. The transition is abrupt, not because conditions are extreme, but because expectations were calibrated to permanence. The system reacts not to crisis, but to deviation from assumed normality. Institutions face difficult choices. Reduce leverage and risk contraction. Maintain exposure and risk instability. Each path carries consequences amplified by scale. Years of optimization leave few easy options. Balance sheets designed for continuity struggle with change. Decisions that once felt incremental now determine survival. Feedback loops accelerate the conflict. As borrowing becomes more expensive, growth slows further. Slower growth tightens fiscal space. Tighter conditions weaken confidence. Each response reinforces the next, transforming adjustment into stress. What began as a policy shift becomes a structural test. Public perception shifts as well. Debt, once justified as manageable, begins to feel burdensome. Narratives change from opportunity to obligation. Trust erodes as promises of sustainability collide with visible strain. The cost of dependency becomes harder to ignore. At this stage, intervention often returns. Rates are adjusted. Liquidity is supplied. Timelines are extended again. The system regains motion, but at a price. Each rescue reinforces the belief that debt will always be supported, even as it deepens reliance on that support. Stability is restored, but fragility grows. The conflict is no longer about whether debt can be managed. It is about whether a system designed to never pause can survive a world that inevitably changes pace. Because debt that never sleeps also never forgives, and when conditions shift, it demands payment not just in money but in flexibility. The reckoning arrives not as collapse, but as realization. The system continues to function. Payments are still made, markets remain open, but the cost of perpetual debt is finally understood. Growth depends on intervention. Stability depends on confidence. And flexibility has been quietly traded away in exchange for continuity. Policymakers respond with familiar tools. Maturities are extended. Rates are guided lower. Liquidity is reinforced. Each action buys time, easing immediate pressure without resolving the underlying dependence. The system moves forward, but on narrower ground. Debt remains serviceable, yet less adaptable. Resilience exists, but only within carefully maintained conditions. Institutions adapt by changing behavior rather than reducing exposure. Risk is shifted. Timelines are stretched. Accounting absorbs strain. What matters is not eliminating debt, but keeping it manageable. The system learns to live with obligation rather than unwind it. This adaptation feels pragmatic, but it reinforces the very structure that created vulnerability. For households and businesses, the lesson becomes personal. Financial planning centers on managing payments, not escaping them. Choices narrow. Opportunity becomes conditional. The future feels stable but constrained. Debt no longer represents leverage alone. It represents commitment to a path that is difficult to exit. Looking back, the danger was never borrowing itself. Debt can enable growth, smooth shocks, and fund progress. The danger was designing a system that assumes borrowing will never need to stop, that refinancing will always be available. That condition supporting leverage will persist indefinitely. The enduring lesson is subtle but profound. Stability built on constant motion is not true stability. It is balance that requires perpetual maintenance. And the more effort required to sustain that balance, the more fragile it becomes when conditions change. Debt that never sleeps reshapes the system quietly, gradually, and persistently. It rewards calm periods and punishes disruption. It encourages continuity over resilience. And it ensures that when adjustment finally arrives, it carries consequences far beyond the numbers on a balance sheet. Understanding this does not mean rejecting debt. It means respecting its permanence and designing systems that can adapt when the motion depends on inevitably slows. Sometimes the smallest shift in perspective becomes the beginning of a new future. Debt